Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We've just released our monthly India market outlook titled Stay Calm and Allocate Broadly. In today's podcast, we discuss two key questions. First, the near-term risk for Indian assets, and second, we discuss structural bull case for Indian assets over the medium term. We highlighted in the previous market outlook possible downside risk to Indian assets in the near term following the strong rebound in the second quarter of this year. Since hitting its peak in July, the Nifty index is down 2%. Nevertheless, momentum remains strong in broader markets as they continue to outpace large cap equities, as the Nifty Mid Cap Index and Nifty Small Cap Index is up 9% and 11% respectively. Yields have spiked, with bond yields in the 3 months to 3-year maturity are up 10 to 16 basis points, while the 10-year Indian government bond yield is up 11 basis points. Over the next 1 to 3 months, we expect volatility to remain elevated across Indian assets as the following key drivers evolve. First, CPI inflation has moved above RBI's upper bound target of 6% over the past 2 months, driven primarily by a sharp surge in food prices. Uneven rainfall distribution and rising crude oil prices, which is now above the $90 per barrel versus the average of 77 barrels between May and July, poses upside risk to inflation. This has led to the RBI stepping up liquidity management operations since August policy. Second, domestic bond yields have moved higher, responding to higher inflationary expectations, unwinding of policy easing expectations, and likely heavy supply of government bonds in Q3 of 2023. The 1-year OIS spread suggests market expectations of no rate cut by the RBI over the next 1 year. Third, the rebound in Indian equities was supported by strong foreign investor participation, with an average monthly inflow of around $4.5 billion between May and July. August flows have slowed to $1.5 billion as relative valuation premium turns richer and prospects for other markets in the region improve. Beyond the near-term risks, we see a structural bull case for Indian assets. We believe India has the potential to transition into an upper middle income economy within the next 2 decades. This transition, which is underpinned by favorable demographics, policy reforms, infrastructure investments, and technological improvements, would bring about transformative changes to the economic landscape and benefit Indian financial market assets. Reforms and policy initiatives focused on revival of the manufacturing sector remains a key driver of our favorable view. Over the past few years, the government has announced numerous structural reforms to address the ease of doing business and revive the domestic manufacturing sector. These include reforms such as goods and services tax, the insolvency and bankruptcy code, and corporate tax cuts, which includes a low 15% tax rate for new manufacturing units set up before March 2024. The government has announced the production-linked incentive scheme, which aims to make exports more competitive. The government committed significant capex outlays during the pandemic to revive the investment cycle to support growth and crowd in the private sector. The PLI scheme aims to offer industry-specific incentives to raise value added and create an ecosystem to raise the value add and create an ecosystem to lower imports, make exports highly competitive. Overall, PLIs not only have the potential to generate incremental revenue, but also the ability to boost job creation and support domestic consumption, which remains the largest contributor to India's GDP growth. Indian assets continue to remain on strong footing. In our view, India's strong macroeconomic backdrop sets Indian financial market assets up to perform well on a multi-year horizon. These include a high rate of economic growth with well-managed inflation and external stability risks, sustainable corporate profit cycle, fiscal consolidation and improving quality of spend given the government's shift towards capex is likely to raise the investment rate, key to sustaining growth. Indian equities remain poised to benefit from several multi-year structural drivers, which include a diversified economy with robust macro fundamentals, healthy corporate balance sheets and strong financial sector health, lower foreign exchange risk, a sustained corporate earnings growth cycle driven by increased formalization, improving capacity utilization and efficiency gains from technological improvements, and lower reliance on foreign investor inflows. We expect fixed income to continue to provide a stable yield in India. India's government bond yields have risen from pre-pandemic lows as monetary policy turned less accommodative. Given the focus on investment-led growth and containing inflation, domestic bond yields are likely to remain well anchored for the next few years. A stable inflation and currency outlook are additional support factors for the bond sector. Private markets are likely to provide long-term alpha. India's private markets have evolved significantly over the past decade, with investments increasing fivefold and the investor base rising fourfold. The industry has received support from a favorable regulatory landscape, notable strides in digital infrastructure, and deepening maturity of founders. In 2022, India's private markets demonstrated resilience in the face of global headwinds, with India's share of private equity and venture capital investments in the Asia-Pacific region rising to about 20% from 15% only a few years ago. In our view, private markets interest is likely to remain strong, supported by a positive economic outlook and structural enablers such as large consumption, opportunity, and best-in-class digital infrastructure. We expect sustained demand from major private equity and venture capital funds in India's healthcare, manufacturing, tech, NBFCs, fintech, and ESG-aligned investments like EV and green energy. Together, this suggests the private market asset class is likely to offer potential for long-term alpha over listed assets. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you for listening, and if you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.